This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and you might be hearing my grandfather clock in the background, striking it right at the top of the hour, which is when we're supposed to begin this. And again, I'd like to welcome all of the newest members, and especially those who are joining us for the first time. It wasn't too long ago. I was just in Las Vegas for the inaugural Market Rebellion Trading Expo, and we had a really good crowd there, and we're picking up followers left and right. We are also doing a technical analysis boot camp in Miami the second weekend of December. That is being organized by John Najarian, Pete Najarian, and his team. You might know the Najarian brothers from CNBC. Fast Money is the name of their show. Feel free to tune into that or record it if you get a chance. I've known John for a long time now, and he was one of my first guests when I had my PBS television show, Wealth and Wisdom, and that was before he got the gig on CNBC. So just to give you a heads up of what's developing, I was talking with Pete, and Pete is putting together an intranet financial program that's going to be very interesting. This is in the works right now, where he will be commenting on stocks. I will be one of the analysts who will chime in mainly from Skype, because they're going to be in New York or Chicago, and I'm not going to go back and forth every week to be on that show, but I will chime in from Skype, where I'll do my live rapid fire stock analysis segment, where we'll have callers call in. So you're going to get a little bit of this tonight, the rapid fire stock analysis, and you'll get a little bit of that later on as that show comes to fruition. So it's really exciting. It seems as though with Charles Schwab lowering their commissions to basically zero, and other companies like E-Trade and I think Fidelity is lowering their commissions to zero. I'm going to explain something to you before we get into the overall market analysis. When a broker lowers their rate to zero, don't think you're getting it for free. It sounds great, but what happens is, and I can tell you from experience being a NASDAQ market maker, the market makers still make money off of your order, even though you're not paying any commission. And here's how it works. Market makers, especially on the opening or right before the opening, I was talking to Rob Langoni about this. They get to see all the orders stacking up into the system. And so what happens is, let's give an example here. Let's say Ford, in a couple of days, is coming out with an earnings announcement. So let's say Ford comes out, and I don't want to jinx my own position, but let's say they come out and they disappoint on earnings, and the news is released, guess when? 5 minutes before the market opens, or it's released 5 minutes after the market closes. What happens is that the professional market makers will be able to take a position ahead of that order flow. So if they see a bunch of sell orders coming in before the opening, they will take a short position before the bell actually rings. And then as soon as the bell rings, they push the market down even further. And then they have all the sell orders hitting, which is the general public, at which time they will then buy. Try to picture this. They're taking a short position. Sellers come in, and they buy from all of the sellers that are coming in on the opening. So they make basically a huge risk-free profit right on the opening, and that's how they make the money off of order flow. And you may not have even thought about that happening, but there really are no free lunches when it comes to investing and trading in the market. And that's just one way they make money. I could tell you a whole slew of different other ways they make market. Just not going to tie up our hour doing that. I'll maybe work some of that in next session and next month's open house Q&A. All right, so again, Kerry, I'm going to get to your GOGL in a minute, but I'm going to first analyze the Dow. This was the chart today. This is the close. You can see this little hammer pattern right there, They did not remove this misprint, and I mentioned this on the weekly market report last Friday, which went out Saturday morning. This long shadow was from a bad print that happened during the course of the day. Someone printed a bad price, and they never took that down. It never got that high. Therefore, this is a false shadow above that candle. My forecast is, even though we were up a little bit, notice we had a lower high and a lower low. So even though this was a green candle, it is still the beginning of a downward leg. I do believe that by the end of the week, we will have this gap filled, and I think that we might even go a little bit lower than that. Notice the stochastics oscillator crossed today with a sell signal. The CCI crossed last week with a sell signal, and the overall upward momentum in this leg is slowing because we have a lower volume day. So I think the volume is going to now start to pick up on the downside. So what does that mean for anyone who has a long position? Well, it means you need to protect your long positions, or at least protect any of the profits that you have in those positions at this point. All right, so that's the diamonds. If we look at the SPY, it's the S&P 500 ETF. We had a higher high and a higher low from last Friday. And this might be a mixed signal, but I still think the S&P is going to go lower by the end of this week. I think that gap will fill. So I'm not going to repeat all the signals as I did with the diamonds, but I do believe that gap is, again, it's open right now, but I think that gap will fill. And that brings me to the VIX, where I think the VIX will start to move up to fill this gap. I've said this over and over and over again. The VIX is an oscillating indicator that's considered to be a leading indicator. And if you go back in time and look at all of the gaps that were left on the VIX, 100% of the gaps, with the exception of this one that's still open, of course, but 100% of the gaps on the VIX have filled. So I can safely stake my reputation on the fact that I believe that gap will fill one day. Right? So take that into consideration when you are trying to trade the VIX, whether you're trading the VXX or you're trading the spiders inversely to the VIX, whatever it may be. I believe that gap will fill, and you can take that one to the bank. So keep note of that. Monitor the VIX. And you can see, unlike the S&P that had a higher high and a higher low, the VIX has a higher low but a lower high. So this is called a half signal. A half signal is when you're almost there, continuing with the trend. The only thing that would give this a full signal would be a higher high, which has not happened yet. We just have a higher low. Now notice the stochastics is starting to go up. It's only a matter of time before this crosses with a buy signal. When the blue %K crosses the red %D, that would be a buy signal. The CCI, the Commodity Channel Index, has already crossed a couple of days ago with a buy signal. I think the momentum will continue to carry this forward. One thing I do not mention is this black line. That's the zero line. And on the CCI, when the line crosses the zero line up or down, that is usually a sign of momentum. Notice back here. Notice when it crossed down below the zero line. Look at what happened. Shortly after that cross, it continued with momentum in that downward direction. You see that? Notice what happened back here when it crossed over the zero line. Well, that would be right around this area right here, right around this bullish engulfing pattern. And it continued to storm higher with that accelerated momentum. I can go back over and over again. Look, when it crossed down below the zero line, was right around here. What happened? It continued lower. Going back even further, look what happened when it crossed above the zero line. Look, continue much higher. So you can take that as a trading tool, not just as a reversal tool, but I'm giving this little bit of information to the folks out there that like to trade momentum, right? There are a lot of momentum traders out there. Fred, I'll be talking to you about that on Wednesday. Craig Ullery is someone who I know has gone through our program who trades in momentum. Constance, you're part of our mentoring program. I will talk to you about that later in the week as well. And so when you start looking at momentum indications and trigger points, keep the CCI in mind. And listen, I don't want you to just take my word for that. Go back and look at all of the times the CCI has crossed over or below that momentum zero line. You'll see that the momentum continues in that direction. So that's also a great thing for short-term option traders who are looking to put on spreads. For instance, if you're thinking about putting on a bullish spread, you might want to put on the long side of a call spread when it crosses over the zero line. And then when the CCI starts getting over the overbought area, which is the plus 100, you could then complete your spread. So that's called legging the spread. All right, Linda Raschke wrote a book about that called Legging the Spread. It's an option book. She was a floor trader as well. You might know Linda from some of her appearances on CNBC and some of the seminar circuit folks who follow her. Legging the spread is a very popular strategy where you lift one side or initiate one side of the spread to complete the other half at a different time. All right, John Wiseman, I know you're into trading some momentum, especially with large positions in equities. Keep that in mind. I'm singling out some of the folks that I know and are familiar with, especially with their strategies. Kim, up there in Canada, you can think about that as well. And Lloyd, one of our regular followers, Lloyd Douglas, welcome back. You can take that as well. All right, so that's the VIX. Now, let's look at the tech sector. Now, one of the things I'm going to point out here is, again, we have the stochastics are about to cross with a sell signal. Same forecast I have here. This is a half signal where you have a lower high but a higher low. If this was a lower high and a lower low, that would indicate full speed ahead, getting ready to fill that gap. So the Qs, which basically represents the NASDAQ tech sector, I would say wait for that gap to fill. And then as soon as the gap fills, I would be watchful for the year-end rally to start to begin. The year-end rally will usually start to take place in November, right around as we approach Thanksgiving and the holiday season. And the reason I'm pointing out the Qs for you here is because after the end of year rally, Santa Claus rally takes place, we then have the beginning of another cycle, which is called the January effect. The January effect, and I will be talking about this more so in December, but the January effect is when the professional money managers start moving out of the large cap stocks in order to capture their big year-end bonuses. And then they start to roll new positions in January into the tech sector or the small cap stocks. So from January right up until April, you'll see a rally. Generally, again, this is the cycle. We generally see rallies in the tech sector. And a lot of times that rally could be opposite or inverse to the general Dow or even Russell 2000. So again, don't think that all the indices rally in sync. They don't. If the Russell 2000 is up, you could have the Dow going down. Why? Because the Russell 2000 is a more broad-based index. There's 2,000 stocks that comprise that index, where the Dow 30 is just that. These are the driving forces in the U.S. economy that you could see, again, move separately or independently from the Russell 2000 and even the S&P 500, which tracks 500 stocks. On my Market Guy Facebook page, I posted an article that came from CNBC this morning where some of the experts are saying, hey, wait a minute, maybe we're not going to see a recession. Maybe this Trump effect is going to carry on for a little while. Well, if you've been paying attention to what I've been saying, I told you that all along, that the Dow really indicates the Dow leads the economy, right? We talked about the DIA in the weekly market report. The Dow leads the economy by about 8 to 9 months. So if you were to start to see the Dow break down major trends or support or even major moving averages like the 200-day moving average, then you might have an argument for a possible recession, because the Dow stocks are the companies that actually drive our economy. And so that's why they are a leading indicator. And according to Dow theory and the way Charles Dow wrote his tenets of Dow theory, the Dow is the leading indicator for the economy, and the VIX is a leading indicator for the S&P. So again, put all the ducks in order and learn how to follow the leading indicators, and you'll be fine. A big shout out to Jacob Godak, a friend of ours who is the field goal kicker for the Citadel, and he used to play lacrosse for me back when he was playing lacrosse in high school. So welcome, Jacob. Jacob is going to be pursuing a career in the financial world. We had a good long talk today, and I told him one of my secrets was to surround himself with success and success-minded people. I will give that out as a freebie to everyone on here. Absolutely true. Surround yourself with successful people, successful traders, and mimic their actions. And that's one way to achieve a good, strong level of success. Don't follow the losers, of course, because guess what? You're going to wind up just like where they're headed. So be careful of that. All right, so that's the diamonds. We talked about the Qs. We talked about the VIX. We talked about the SPYs. Let's talk about the Russell 2000. Again, here is the Russell 2000. It did hit my target from last week. Remember, last week I drew this line as an upward sloping trend with the end of the line right there being my target. Today we hit that target. You see the long shadow above that candle. Now I believe the Russell 2000 is going to start to head lower. Again, this was a higher low, higher high, unlike what we saw. Remember what I said, the Russell 2000 a lot of times will trade or stand separate from some of the other indices. So again, I think now we could start to see a little bit of a pullback in the Russell 2000, and that is going to be my overall market spin. Finally, OUSA, I picked this one up. I'll repeat this for those who didn't get word on this one. When I was in Las Vegas, I had the good opportunity of meeting with Kevin O'Leary, who a lot of you know is Mr. Wonderful from Shark Tank. Kevin is the creator and manager of the O shares, kind of a little bit of an ego there where the O shares, O'Leary shares, kind of mimics that. But Kevin created this as more of a cross-section of the general market. I wouldn't call it a leading indicator because some of the top holdings in the O shares are Apple. I think Apple is one of the top holdings, if not the top holdings. They have Home Depot in there. They have Verizon. They have, what's some of the other stocks in there? I think some of the pharmaceutical companies are in there. Amgen, I think, might be in there. And so I am going to be reporting on this weekly, not to promote his fund. I get absolutely no money from Kevin O'Leary to promote and tout his fund. Do not. In fact, last week I mentioned that, I hope Kevin's not going to be mad at me for telling everyone that I think the shares are going to drop, but I think that's going to happen. We have heavy resistance up here at the top with a gap below the market. Now, our option traders have a sophisticated spread that's more or less a pairs trade where we're long the O shares at around 34.06, I believe. Yes, we bought these at 34.06. We're already up 52 cents on the long position, and we sold a credit call spread in Apple as a pairs hedge. Now, I'm not going to get into that strategy, but if you are interested in trading options and you want to learn some of these spreads that I put on, then go to my website and subscribe to the Options Oracle. It's a trade alert service it's priced fairly, and as long as I can help people make more money than what they pay me in the subscription, everyone wins on that. So that's O-Shares. Now, I did get an email from Kerry. I'm going to actually read some of it, not all of it, as I go into GOGL. I'll give it the snapshot here. Kerry says that he is long in the money calls, December calls at the $5 strike, and Kerry bought these calls for 95 cents. Now, if you look at this, I have to minimize my screen there. Okay. The calls that Kerry bought for 95 cents are currently 90 bid to 130. So Kerry wants to know what my technical spin is on this. Now, I'm using Kerry's question as more or less the layout for how I would ask you to pose your stock symbol. If you want me to analyze one of your stocks right now on this call, tell me what your position is or what your idea is or what your concern is before I get into the spin. Now, again, I know Kerry is long in the money calls on this. So Kerry wants the stock to go up. Well, according to what I'm seeing here, it looks very good. However, there is one little gap down below the market. So there is a chance that this stock could pull back before going higher, right? Because gaps do fill 80% of the time. And if you look back at all the gaps that this stock has filled, and there's quite a number of them, you'll notice that the majority of gaps do fill. Here's one where it gapped down 2 days in a row. Eventually the gap filled, and then went higher and it filled. Now here's if you're not following or haven't followed my gap fill strategies, 80% of the time, don't take my word for this, I want you to check it. 80% of the time when a gap fills, or I should say 80% of the time gaps fill, but after they fill, 80% of the time, the stock reverses. This happens to be pretty choppy, this particular stock has a lot of movement, but it's also thinly traded. Something you have to consider, Kerry, when you are trading options. There's not a whole lot of liquidity. In fact, if you look at the volume on this one, it only traded 206,000 shares today. I like to get in stocks that have at least 500,000 shares for the liquidity reasons, but you got to be careful because this one being so cheap can be manipulated. All right, now let's back up a little bit. I looked at the daily chart. Let's go to the weekly chart. I'm going to draw some lines here. I'm going to connect the highs going down just like that. You see that? So I connect that high to that high and project out. Now I'm going to connect this low, connect it to this low, and project out. What is that? That's known as a symmetrical triangle. Triangles are very, very powerful patterns that are traded quite often by swing traders. How do you trade a triangle? Well, the way you trade a triangle is first identify the resistance and support. In a triangle, support is converging upon resistance. So we have lower highs and higher lows. Think of this as we get to the apex of this particular triangle, eventually there will be a breakout. It could be up or down. I'm guessing that this one will eventually break out to the upside. Why? Because if you look at the weekly volume, you got to remember today's Monday, so this means nothing. We still have Tuesday through Friday to mount up some significant volume. But if you look at the volume over the past 3 weeks, the volume has been increasing on the buy side. We have a bullish engulfing pattern here 2 weeks ago. Bullish engulfing patterns go up, or the price follows in an upward direction 80% of the time. Again, we get that 80-20 rule on gaps. Look at the bullish engulfing pattern right here. See this bullish engulfing candle? What happened 2 weeks after that bullish engulfing pattern showed up, the stock went from $4.70 all the way up to almost 6.5. That is a significant rally, right? Here, again, we have an engulfing pattern. It's still considered an engulfing pattern because you have a big green candle engulfing the previous body right here. And what happened? That stock went up again. So we have the bullish engulfing pattern followed by green candles on stronger volume. Remember, this is a weekly chart, which is more impactful than the daily chart. In other words, the weekly candle carries more weight when you're looking at the signals than the daily candles do. So we have a cross buy signal on the stochastics. If you want to learn about stochastics, go to my website, learn about stochastics. I have a free video that teaches about that. And remember what I talked about with the zero line and the CCI. I'm going to zoom in here. Look down here. This black line is the zero line. Most of the time, when, I'm saying the large majority of the time, when a price breaks out over the zero line, like we see back here, what happens? This was a very significant upward move. I'll go back again. Look what happened back here when it crossed over the zero line. Big upward move. Again, what happened here? It crossed over the zero line. Boom, another big move. Doesn't look like much, but it went from 5 to 630. That is a huge, that's over 20% price move in a month. 20% gain on that share price. If you're not excited about this right now, then either I'm not talking loud enough or clear enough, or you're just not paying attention. This is what keeps me up at night. When I see signals like this, you got a bullish engulfing pattern here. Look at this, a bullish engulfing pattern, and then you got a cross over the momentum line. So if you're just you're looking to capture profit, this is your area that you look to capture profit in. If the only thing you use is the CCI to get in on a stock like this, then so be it. Buy the stock when it crosses over the momentum line, set your stop below the most recent low, and then trail your stop up as the stock goes up until what? Until it gets overbought and starts to hinge lower. So my point is, I'll draw some vertical lines here. So you get long the stock when it crosses over the zero line, and when it starts to hinge lower, you get out. Done. End of trade. You don't even have to know where the price is. You're just following the CCI. The Commodity Channel Index leads all of the other oscillators. I find it to be the most beneficial and valuable oscillating indicator that is out there, the CCI. Just because it's named Commodity Channel Index doesn't think you use it just for commodities. I used to use it when I traded commodities, but you can apply the formula to stocks as well. All right, now I'm going to keep this moving very quickly. Start typing in your stock symbols, and let's see who's the first one. TOS. Okay, Thinkorswim. I thought that was a stock symbol you're putting in, Fred. Yeah, Thinkorswim has lowered their fees as well, but guess what? If you're an option trader, you still pay commissions. So that makes you the most valuable clients to these brokerage firms. If you trade options and you trade a lot of options, guess what? You have negotiation power because they certainly do not want you to be going to their competitors. Option trading is very, again, profitable for the brokers, and they will take care of you. All right, so I see Tim is looking at ABT. That's Abbott Labs, I believe. So let me put ABT in there, see if I'm right. I do believe. Yeah, Abbott Laboratories. And while we're on the weekly chart, Tim, I don't know if it would be worth waiting for a pullback, because if you look at the weekly chart, the buy signal came on the CCI, and the buy signal is showing up today or this week on the stochastic. So you got a stock that's in a significant upward sloping trend right there. I think that's a bullish engulfing pattern, if I'm not mistaken. Yes, you have a bullish engulfing pattern last week, and you have the volume increasing as the stock is pivoting up. So on the weekly chart, everything that I'm seeing, the bullish engulfing pattern, the increase in volume, the cross on stochastics, the cross on CCI, everything on the weekly is telling me buy it. Now let's switch to the daily chart. The daily chart, don't be freaked out about this, but today there was a bearish engulfing pattern, right? So what I would do with Abbott Labs is I would be a buyer anywhere in this area over the trend line, anywhere over this. I would be a longer term buy, accumulate, or buy, hold the long-term options. I like Abbott Labs. Let's face it, any of the drug makers out there, I don't think they're going to lose money. Why? Many reasons. The healthcare system still favors the drug companies, even though President Trump has been cracking down on the drug makers like Pfizer and some of the other, even the biotech companies like Amgen and such. These companies are going to overall continue to make money. They're in long-term upward sloping trends like we saw in the weekly chart. But you know what? If I go back even further, look at this monthly chart. These things are still storming higher. This is a 20-year chart. Is there room for a pullback on the monthly chart? Yes. But as long as you're protecting yourself below this long-term trend with stops or options, I don't think you could go wrong. And if you are threatened, then you know exactly where to manage your risk on that. Now, there's another thing with regard to Abbott Labs and some of the other companies like Pfizer. They are stocks that have good liquidity in the option markets. If you look at Abbott Labs, I don't know why that didn't switch right there, but I'm going to type in Abbott Labs, and there's the options. You can see that the options are fairly tight in the spreads. This is a December option, and look at the bid-ask spread. There's only a 30-cent spread between the bid and the ask. That's pretty efficient. Here you have a 10-cent spread between the bid and the ask. At the money here on the 85s or slightly out of the monies, you have a 4-cent spread between the bid and the ask. That equals liquidity, so you can get in and out fairly easily. And this is a dream for the option traders, especially those who are looking to trade calendar spreads. Okay, so Tim, hopefully that helped you out. Now, David Bernstein, welcome. David's a big VIX trader. He also trades the indices. I've spoken with David quite a good number of times. Just look at TLT. And right there, this is the iShare for the 20-year trust. Why is my TLT? It's not switching here. Hold on, bear with me. I hope I have a good internet connection, David, here. All right, so David, you just put in the stock symbol, but I'm thinking you're looking for an entry point. All right, now here's a good example of gaps. Remember what I said, 80% of the time gaps fill. Here we go, the gap filled. 80% of the time after the gap fills, what happens? It reverses, right? Here, again, here is a gap that ultimately, well, it came very close to filling within pennies and then reversed. So now you have, let me erase the lines here. Let me show you why I'm more long-term bullish on this one than bearish. All right, so take good notes, David. Today, TLT gap down. So you have a gap above the market here. It's going to act as a price magnet. That's number one. Number two, you have an unfilled gap here. That's going to act as a price magnet. You have another unfilled gap here. This one did fill and reversed right there, but you have an unfilled gap up here like I just mentioned. So you have 1, 2, 3, 4 unfilled gaps above the market. You have stochastics, the stochastics oscillator. The K line, the percent D, is starting to hinge up. It is by definition oversold. I think that's going to eventually move up, create a buy signal. This is kind of floundering right at a buy signal, but any kind of an upward move tomorrow or the day after, David, is going to create another buy signal on the CCI, right? So I am going to forecast this just like that. I think over the next week and a half, 2 weeks, this could easily go from 138 up to 146. Now, here's why I'm being so bold as to forecast that, not just in price action, But notice how I drew this line. This is just going to be a lesson in what's called speed lines. A speed line is when you're more or less tracking the trend or leg of the trend by connecting the middle of the closing prices. See this right here? This is a speed line. It's not a trend line. I'm basically trying to find the middle of that trading channel and giving you the angle. See the angle of the former speed line? It's parallel to what I just drew here. That's why, so I didn't tell you when I was doing this because I naturally do this. My eye picks up on those angles. So I'm being very conservative when I say this gap could fill because that would be a target resistance area right around 146, 147. But notice that my line starts here, ends here. What would be the date? Can anyone see the date of that? Notice the date. It ends at 145.45. See my window that pops up? On 11/15. So I think that by November 15th, we could be at that price. I don't often talk about time goals. I talk about price targets, but I very rarely set time targets. I would do that for David right now because I know David trades options and he's going to be interested in understanding which option to pick. All right, so hopefully that helps you out, David. All right, now, Richard, I see some text in there. I'm going to go right into RY, which is your request. And then I'm going to read I have to expand this a little bit. Let me see if I can Windows next. All right, I'm going to have to scroll through because there's a lot of text in RY. Bought this stock December 2018 at $74.25. Held the stock for dividends. That's great. So you're making money all the way around. Has RY now in a cup and handle formation from July, September? Yes, I would say absolutely it is in a cup and handle. If you're not familiar with the cup and handle pattern, here is the cup, here is the handle. In order, let me just erase all lines to make this nice and clear for Richard. Let's see, clearing the drawing set. A cup and handle is when you take former resistance and you connect it to current resistance. You draw it as a flat line. That means horizontal line from high to high. It's okay if it intersects some of this price action. It looks as though Thursday and Friday we have a breakout over and above what's called the brim, also known as the rim of the cup. Remember, here's the cup, like a teacup. Here's the handle. Someone that's looking at charts for the first time is probably going, what kind of drugs are you smoking? They got cups and handles, and what happened to good old fashioned just analyzing price and volume? Well, price formations are followed very, very closely by swing traders and even longer term, I would say more intermediate traders, right? So when you have a cup and a handle forming, they're paying attention to this resistance area, right? Now, when the volume, see, look right here, on this particular day, it breached or started to break out over the brim. Notice the increase in volume here, right? Then it continued to go higher. So what I would say is there's a good chance it's going to go even higher than this, and I'm going to have to back up to the weekly chart to really give you that spin on that. There is some slight resistance up here you got to watch out for. But I think this stock is on track to get up to this resistance area up around 87.50. Now, I don't think it's going to happen overnight. Let me look at my angles here. I think you could see that happening actually by January. Now, this could be one of the stocks. This is the Royal Bank of Canada, all right? And so if you look at this one, it could very well increase to that level, maybe even benefit from a year-end, aka Santa Claus rally. And if you're long the stock, I would continue to hold it through the next dividend cycle. However, if there are options on this one, Richard, I would say, hold on, let me see. There are options. See, it's not switching back and forth. I think maybe because I have to link that, but I'll type it in manually. Let's just see something here. Are there options in January? Yeah, there's options, but they're not paying a big premium. I was going to say, if you really want to play this one and be safe, sell the $85 calls in January and hold it, because that would be like a dividend enhancement. If it goes over 85, I don't think you're going to be too upset to collect another $1.73 on that. I don't think you'd be too upset if it goes over 85, at which time you'd be called away, but that would be in January, and you would get maybe another 90 cents on top of your dividend payout. All right, I call that the dividend plus, or the golden buy right strategy. I created that many years ago. It's a covered call, but you're selling a longer term option that expires after the pay date, right? After the pay date or even the X date, you can absolutely collect an added premium by selling the call and collecting that time value. So hopefully that helps you out, Richard. All right, let's go. We still got some more stocks to analyze right here. Dave, don't worry. If you're late, you're calling in from Kosovo. Wow, thank you. Thank you for joining us. What time is it there? It's way early in the morning. Okay, so let's, Dave, if you have a stock symbol, type it in. And if you were late, don't worry. This is being recorded for all of our members. You can catch the beginning by listening to the recording. All right, now, Ray made a statement, said that he bought put options today on all of the symbols that were mentioned. Good for you. Ray, hopefully you bought the right options, though, not the weeklies. Try to buy some further out options that are more in the money. I think that would help you out. Jeff Summer, dialing in from Florida, asking me about GDX. Now, Jeff is a trader. I went to his office, his home office, his home trading. I'll call it the trading cockpit, right? And Jeff has multiple screens. It looked like, I would have to say, like mission control at the Kennedy Space Center there. And Jeff is asking me about GDX, the December calls, all right? And he wants to know where that's going. So, bought calls on GDX. Again, this is not crossing. I'll have to type that in again. And let's go. Right now, Jeff, you got to watch out on the weekly chart. I see a bearish engulfing pattern close below that moving average. So be really careful with that. Let's see what the daily chart looks like. I'm not liking it, Jeff. I hate to say it, but you bought the calls at 170. I think you're in jeopardy of losing some money there. Here's why. You got the bearish engulfing pattern showing up below the 20-period moving average. 20-period moving average is going to act as resistance. That's bearish sign number one. Bearish sign number two, the bearish engulfing pattern. Bearish sign number three, you have an increase in volume on the way down. That's telling us the sellers are motivated to sell. That's point number four. Other bearish indicators are the K line is starting to hinge lower. It didn't cross with a buy signal. It's a failed buy signal. That's bearish sign number four. Bearish sign number five is the CCI is starting to cross back down, showing downward momentum. Now, if that's not enough indications for you to get out and salvage whatever you can on those calls, I don't know what else is. If you feel like you still want to hold on to them through December, then you're going to have to ride it lower before it bounces, because the next level of support is going to be down here. So I think there is a possibility that it can move lower and then bounce. But then again, where will it bounce to? Maybe, I think best case scenario here, Jeff, is that it bounces, and that's going to bring you into November, which you might experience some of the January effect rally on GDX. Because the gold and silver, if you watch, they don't always trade in sync. A lot of times they trade inversely to one another. But when you're trading the GDX, you have to also watch GLD. All right, and you see GLD, and you can see that this also has an engulfing pattern, bearish engulfing pattern. All the signals are pretty much following suit there. So again, I don't want to beat the dead horse here, Jeff. Just be really careful with that one and let me know how it goes. If you really, I hope, don't get yourself in trouble and buy more. It costs average down. I'd be really careful. I limit my risk on that and move on. All right, so John, another one of our mentor students, owns DRN. I'm going to take a look at this one. Wow, I'm looking at the clock like, what the heck happened to 45 minutes? It just vanished. All right, now, John owns DRN, tied to the real estate market. I think, a little typo there. I think you're meaning you're long in DRN. It's choppy. I'm not going to correct your typos there. Don't worry about this. This isn't spelling class. This is trading class, all right? But the tendency is long. CCI is still up. Where's the top on this rally? Trailing the stop at $1, by $1. All right, listen. Here's what I see. Good news is, and we're going to take it in this order. The good news is you have a breakout. By definition, that's a breakout of the previous high, and the breakout is occurring on higher volume. John, when I was in Las Vegas, the whole presentation was on volume, the forgotten leading indicator. If a stock is going vertical, how high can it go? Well, that all depends on volume. If the volume is increasing, so you want to see a big increase in that volume compared to today's volume. If the volume is any less than what it is today, then I would trail your stop up, and I would do that very quickly, because a drop in volume, let's say tomorrow you have a volume that's 25 to 30% less than what it is today, that's telling us that the buyers are losing some of that momentum. Now, what I would think is, if you do get a drop in volume, former resistance could turn out to be support, right? So if you're trailing your stop by $1, that may not be enough, actually, because if it's trading 32 and it drops to 31, guess what? You're stopped out, and now it's bouncing off a newly established support. So I would put it slightly below that, or take half your profits tomorrow, no matter what the price is. Take half your profits and protect the other half with the stop below 31. All right, so you want your stop to be below support. All right, if you're interested in learning more about the role reversal and how that's managed, go to themarketguys.com, click on videos, and I have a video, short video, 7 minutes long, that talks about the role reversal and how to draw it, how to trade it, and what it all means. So hopefully, John, that helped you out. Oh, I see on your next comment you corrected your own typos. All right. All right, let's see. Hendra, welcome. Hendra says, what is a good entry point to buy BAC? I believe that's Bank of America. Let's see, BAC. Bank of America Corp, yes. All right, now here's what's happening, Hendra. You have a resistance right here. Boom. Be very, very careful that you are not buying as the stock is bumping its head against that ceiling. If you do not get a breakout tomorrow, and or you don't see a breakout and the volume drops tomorrow, then guess what we can expect? We can expect a pullback. And I'm more inclined to think you're going to get a pullback for more than a few reasons. Number one, the price gapped up today. Gaps usually fill. So this most likely is going to act as a price magnet to draw it down. Second thing is, if you were to look at the distance, or what we call the divergence from the 20-period moving average, you could notice that in the past, the stock does not like to move that far away from that moving average. It's called the rubber band effect. Again, I have another video about that in my video library. When the price of the stock gets stretched far away from that moving average, above or below, you'll notice back here, it does not like to go that far below either. Now, you could take a straight edge ruler and measure the distance, and it's pretty much the same. Even going back here, if you notice from here to the highs, very, very close to the distance of the divergence there. Again, go back. Same thing on the downside. Does not like to move that far below. So I would say there's a greater chance that the stock is going to pull back than to break out. So if you're looking for an entry point, I would set a price alert for the 20-period moving average, which is right around 29. See back here, the 20-period moving average often acts as support once the stock pulls back to it. You get a lot of times, see it pulls back and then it bounces back here. See where my cursor is? Here it pulled back to the moving average, formed a hammer pattern, and then rallied. So I would set a price alert. If you're using the TD Ameritrade platform, all you have to do is right-click your mouse, and you could set an alert. So if I want to set a price alert on this one, I am just going to say, okay, at or below 20, I'll put 29 on that one. Okay, so actually I'll put 29.01. I'll put it right at the 20-period moving average, right? So I'm going to set that alert, right? And then I put possible buy, right? Check charts. Check charts. Boom. Again, you don't have to have TD Ameritrade to have this feature. I would say 99.9% of all the charting platforms out there have the ability for you to set an alert that allows you to add notes to your alert, all right? So if the stock gets down to that level, I don't even have to have my computer on. It'll just send me an email or a text, hey, go check, go check the price of Bank of America. I think I have this on my watch list, if I'm not mistaken. If I don't, I'm going to add it. No, I do not. I'm going to add it to my watch list, and I'll track it with you. I can't say I'm going to give you a personal phone call to tell you when to buy that, but I will definitely be watching it with you. BAC right there on my watch list right now. So I have my alert set, and we might actually have a buy candidate if it gets down to 29, starts to pivot up. I know I'm talking quickly. I apologize, but I'm trying to get as many stocks in as I can. All right, so Ron Burr, welcome. Ron is a longtime follower of the Market Guys. He's asking me to look at HCP. We have a lot of people on this call, by the way, and hopefully you are enjoying listening to my voice as much as I enjoy presenting to you. There's HCP, and Ron's question would be, what would be a good entry point? Now, folks, if you notice, if you've been doing these calls, these webinars with me each and every month, you'll know that most of the questions that come in involve a long position or a buy idea. Now, if I've told you that we still have 2 weeks left in the month of October, which is one of the worst months of the year, you shouldn't be too aggressive with that buy idea. You follow? Now, back here, I must have analyzed this before because I said this was my forecast line, and it looks like we did reach that end line target, but I'm going to erase all this. Now, watch, Ron. Look at the oscillators first. You can see that the price is going up, but I'm going to talk about this for a second. See the colors of these candles? That's important because we have 1, 2, 3, 4, 5, 6 green candles in a row. 6 green candles in a row. You'll notice back here we have 1, 2, 3, 4, 5, 6, 7, 8 candles in a row before it started pulling back slightly. This stock is still in a significant upward trend. However, I think we're long overdue for a red candle and possible pullback. So I think the stock could actually pull back about $1, $1.25, at which time, this is another one like HCP, I would put my alert pretty close to the 20-period moving average because this former resistance, once broken, acted as support. And if it pulls back to support, there's a good chance it's going to pull back to support and bounce. So right around the 36 and a quarter area, I would then look at that one. And Ron, I'm going to put this one on my watch list as well because I think it's a healthy stock. I like the way it looks technically, and I might actually wind up that one being a buy candidate one day. I tell people this all the time. like I said, we have a lot of folks that are listening in right now. I come up with buy ideas every week in the Trade Alert service. But with the great things about having a community of traders and investors meet once a month on calls like this is that we have hundreds and hundreds of eyes on the market now. Where, for instance, Ron says, hey, can you take a look at HCP? That one was not on my radar. But guess what? Now it is on my radar. And so just being a fly on the wall, you might come up with a good buy candidate. And I'm not saying buy this one right now, but I'm saying it's a possible buy on a pullback to that role reversal support. All right. Keep that on your radar, Ron. I am. Hopefully you will too. All right. Now, Phil's another follower. Boeing does not have a position. What do you think of purchasing shares after the earnings report on Wednesday? And then writing cover calls for income. All right. First of all, have you seen Boeing today? Ticker symbol BA. This thing got slammed today. Slammed. However, I'm not telling you try to catch a falling knife, but let's look at Boeing, right? I got out of my Boeing position a while ago, but I would most certainly be very happy to look at Boeing again as a buy candidate. Here's why. And I'm gonna give you all the reasons. Here is a major support level right here. We're pennies away from that. That's buy signal, or that's a bullish signal number one. Bullish signal number two, as I zoom in, this is called a hammer pattern. Let me make this more parallel. Hold on. I want to get this straighter because that needs to be problem. I'm going to take that low right there, and I'm going to go parallel. That's called the flat line support. When you go parallel from the previous, there we go. This is a hammer pattern. Hammer patterns are bullish. Boom. That's bullish signal number two. Bullish signal number three, I'm going to drop right down to the CCI because even though this is oversold by definition on the CCI, interestingly enough, it's hinging higher. Remember I said about the CCI, it leads the stochastics usually by 2 to 3 days. So I think 2 to 3 days from now, stochastics, while it's oversold, will most likely start going higher. All right, so that's, again, see how the bullish signs are starting to stack up. The other signal is that, boom, there's a gap above the market. Doesn't look like much, does it? But that gap is around almost 344, right? 344, that's $14 above where it is right now. So, Phil, if you're thinking about buying the stock, I would rather see you buy the leaps, right? Because the leaps are going to be far cheaper than spending, $300 per share. You could buy a leap as a stock replacement strategy, buy an in-the-money leap. Again, this is only for option traders who are familiar with options. You buy an in-the-money leap, it's going to go up in value as the price of the stock goes higher. Now, Boeing is most likely going to be my next buy candidate for the option traders this Wednesday. I'm going to wait just a couple more days, though. I'm going to wait. Even though I think there's a short-term trade waiting to happen like any day, any hour now, I'm still going to wait for the pivot point to form. The only thing that I would wait for, in fact, I might even put out alert tomorrow if the volume is super, super low, right? If you get a drop in volume, if you get a 20, 30, you might even see a 50% drop in volume tomorrow, that would be bullish. Why? Because news out on Boeing is very negative. Obviously, that's what caused the knee-jerk reaction to gap lower. But when the volume starts dropping, that is the leading indicator that tells us the sellers are starting to ease up on the selling pressure. You understand that? Volume is a leading indicator because it gives us insight as to what's going on in the minds of the sellers who are driving the price right now. That's what's happening. So keep an eye on that. I really like Boeing as a long candidate, but the timing has to be right. For the option traders out there, if you're looking for the trade, I would go further out into January 2021, right here, and I would look to buy probably. Why did it switch? Darn it. Okay, I got to link that next time. All All right, so look for the 2021 leaps. And I would go 2 strike prices in the money. I would probably maybe even go 3 strikes. I would look to buy these for around $49 right here. The 320 calls for $49, I think, is a better choice. And then as the stock goes up, there's lots of things you could do against that long position to turn it into a spread, to a calendar spread, vertical spread, whatever you might want to do. And I think there's money to be made in Boeing. But again, the timing has to be right and the signals have to be perfect for you to get in on there. Folks, I did not run out of energy. I didn't run out of excitement. I didn't run out of anything but time. It is now 9 o'clock, and I cannot believe an hour passed that quickly. I want to thank everyone for joining me on this action-packed session. Please be sure to visit the Market Guys website. And for those who are part of the Market Rebellion movement, keep driving forward, keep learning, keep passing on the knowledge, because they certainly don't teach this in any of the colleges or universities, and that's really a shame. So have a great night, everybody. We'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.